there, welcome back to another FinArk Academy video. In this video, we will highlight the common investment mistakes most people make. We will show you what an experienced investment advisor is able to deliver to you, as well as teach you how to discern whether your financial planner is able to provide you quality investment advice or not. Without further ado, let's get into the video. Here are 3 common mistakes that investors make. Number 1. Inadequate understanding of investments. Many investors adjust their investment behaviors based on what they feel and think is going to happen in the market based on current news. However, often the piece of information they base their investment decision is merely hearsay and may just be one piece of information that does not reflect the entire situation. This leads to an inaccurate perception of reality. When we invest based on wrong assumptions, it will likely lead to losses. Number 2. Placing all your eggs in one basket. Many investors typically have most of their assets focused on one asset class. For example, if they really believe in stocks or property, then often they are overweight on stocks or property. If the investor is conservative, basically all their wealth is locked into fixed deposits or short-term endowment plans without considering factors like inflation. Investors may lose a lot of money when their understanding of the situation differs from the reality of the situation, such as losses in fixed deposits. In the past, when interest rates remained at 0% for extended periods, inflation ate into the retirement savings of many. And when rates hiked up, it affects many different asset classes such as stocks and properties. Should that happen, it will lead to losses as all your investment are concentrated into one basket. Number 3. Making emotional investment. When the market is going up and everyone seems to be making money, some investors might feel overconfident that their previous investment decision is right and that investing more money at market peak is a good decision. However, when the market subsequently crashes, then the opposite might happen. Those who once felt very confident might then feel very fearful and lose confidence in their investments, and this might lead to wanting to sell their investments at the bottom of the cycle. Emotional decisions like these can lead to buying high and selling low, which is the opposite of what investors should be doing. So, what value can a financial planner who understands investment deliver to you? First things first, a customized plan fit to your financial situation. A competent financial planner will ensure that you have a well-balanced investment portfolio that fits in with your overall financial situation. This ensures that you have sufficient insurance coverage in place to ensure that should critical illness strikes, you will still have your investment portfolio intact, rather than having to sell 50% out to cover your medical bills. A specialist who is able to prevent you from having to sell out of half of your investments can support you to make informed investment decisions based on your specific financial situation and goals. Secondly, a customized investment portfolio. The portfolio should be customized to your time horizon and risk profile, along with your investment objectives. The recommended funds should be based on the objective advice of the macro situation, with strong basis of recommendation, and forms a diversified investment portfolio that you are comfortable with holding over the medium term. Third one up, investment expertise and know-how. A competent investment specialist will keep themselves informed on what's happening in the market and understand the risk-reward trade-off for various asset classes given the existing economic climate. If your financial planner is not specialized in investment, then this function of managing your investment portfolio would be left to the fund managers of the unit trusts you invest in. While past track record does not guarantee future returns, it can be used as a reference point to assess their competency in investment portfolio management and a guideline to how much you will make. If in doubt, always diversify, even between investment advisors. Fourth quality, simplifying complex financial concepts. A competent investment advisor should be able to simplify complex concepts and explain them in terms that are easy for you to understand, enabling you to make informed decisions about your investments. Lastly, monitoring and adjusting your portfolio. A competent investment specialist will monitor your portfolio, this in order to recommend shifting exposures. They will also review to ensure it stays on track to meet your financial goals. Most importantly, an investment specialist can help you to save time. Learning about investments can be a time-consuming endeavor, especially if you are new to it. Investment specialists tend to have a passion for the markets. They spend thousands of hours understanding the markets to discern what is true and what is not. They also stay up to date on market trends and investment opportunities. While there are many financial planners in the market, with each financial planner having differing degrees of knowledge and investment competency, this leads to a difference in the quality of advice provided to clients. Here's how you can determine if your investment advisor is competent to serve you in managing your investment portfolio. Number 1, do they care about you? Do they find out what you seek to achieve? Your risk appetite and the type of investments you prefer? Do they ask you to invest an amount of money you are comfortable with? Or do they ask you to invest everything you have and even take on further loans to invest? Do they pressure you to decide? Do they monitor your portfolio after that? Number 2, what is their experience and track record? It takes time to build up sufficient exposure and understanding of the markets, and the competency of an investment advisor is usually reflected in their track record of their client's portfolio. In the absence of which, a dedicated advisor will leverage on the skill set and knowledge of more experienced investment professionals. And lastly, number 3, what is their investment philosophy? How do they manage their clients' funds? A competent investment advisor should be able to articulate their investment philosophy, how they could add value to their clients, and articulate in a way that makes sense to you. Through this video, we hope that we are able to communicate the need for an investment advisor, the value an investment advisor can provide, and how to discern if your investment advisor can add value to you. By outsourcing your investment decisions, you can focus on other areas of your life that bring you fulfillment while still ensuring that your investment portfolio is taken care of. If you enjoyed our video, don't forget to hit the like and subscribe buttons, and turn on notifications to be informed of our next financial video. See you next time!